Housing costs are up, insurance is up, gas prices are up again. So what happened? The consumer price index, it rose to 3.5% in March. Producer prices at the wholesale level, they are still elevated, but they came in just below the expectations. So what happened to mortgage rates? They actually jumped to 7.25%. And the Fed rate cuts, well, it's a matter of if, not just when, they're going to lower the rates. So hi, this is Mike Wise with your weekly mortgage update. In regards to the headline CPI, it was up 0.4% month over month, and year over year it went from 3.2% to 3.5%. The core CPI went up by 0.4% month over month and was unchanged year over year at 3.8%. So the biggest impact right now that was impacting the inflation on Wednesday, the CPI numbers, was the shelter costs. These numbers, along with the motor vehicle insurance, which jumped 22% year over year, those two alone were 0.3% of the increase in the CPI. So just shelter and auto insurance increased the CPI by 0.3%. Below is a chart of some of the selected categories, and you can look at the inflation and how it's impacted every little selected categories of the economy. Also, there's a link to a podcast by Lawrence Yun, the NAR economist, and that goes over the inflation, the CPI numbers as well. You might be interested in that. The producer price index, which measures the inflation at the wholesale level, came in on Thursday a little bit lighter than expected, and it was still up year over year, but it was lower than what they expected. So not much is happening in the market from that. Most of the rate increase came from the CPI numbers. An interesting note that came out on Wednesday were the Fed minutes from their last meeting. And there was something that was very positive, and there's not much talk of it going on right now, but in the minutes, there's talk of them actually slowing down the runoff of their portfolio. And I can get real technical here, but what this really means is that the Fed may jump in and start buying treasuries. What will this do? Well, this will help stabilize rates and possibly even bring them down. So the chances of the rate cuts are slowly diminishing, but if the Fed actually starts buying treasuries, this could help bring down the rates even further. So election time is always interesting, and the Fed buying treasuries or lowering rates, somehow, election time frames, the rates always seem to go down. So we will wait and we'll see what happens. But right now, we're in an increasing interest rate market right now, and I wanted to touch on buydowns. The temporary buydowns, they're a great way to help lower your payments for the first few years. But what we are seeing is that the original 2-1 buydowns that we were out there selling, they can be kind of expensive. So let's use an $800,000 loan, for example. If we do a 2-1 buydown with a note rate starting at 7%, then the first year is at 5%, the second year is at 6%. The cost of this buy down is actually $18,000. So to soften the blow, we have a 1-1 buy down and a 1-0 buy down. The 1-1 buy down would only cost about $12,624, and your payment would be $526 lower for the first 2 years. The 1-0 buy down is even less expensive at $6,300, and you would still save that $526 for the first year. Both of these are great options to the 2-1 buy down, keeping the cost down and your payment lower for the first 2 years. In addition to the temporary buy downs, don't forget about our list and lock and save program, and you can click here and learn more about how your seller can offer a discounted rate to their buyers. This is Mike Wise with your weekly mortgage update. I will be available this weekend. Give me a call, shoot me a text, and we'll see you next week.